This workshop is about federal tax compliance for small businesses, and so I'm going to be sharing some key insights and best practices. Some of the main topics that I'm going to be covering this morning is key federal tax obligations, common tax forms, so income reporting, maximizing deductions, and staying compliance. And then we're going to wrap it up with question and answers, and then closings. So who I am? Well, my name is Cristina Cayas. I'm the CEO and founder of Elite Accounting and Tax Consulting. My education, you're going to be here sitting with me for the next hour, so you want to make sure that, at least I'm prepared to do this workshop. So I have my MBA in accounting from Rutgers University and my bachelor's from Montclair, in addition to other certifications that I've been getting along the way in my career, including tax preparation and certified also by the IRS. When it comes to my work experience, I have over 12 years of experience in accounting, taxes, and payroll, and that comes from the private and public sector that I worked in the past before. And it was during the pandemic that, like many of you, that I saw this struggle that a lot of small businesses were having, since I have friends and some people that I know that own small businesses, and that I saw the struggle, and that when I decided to, shift a little bit my career and focus more on those in this industry. I registered my business in 2021. However, I didn't go into that fully until last year when, I decided to take this as a career path and fully focus on that, because I saw the need that a lot of small businesses need support, especially when it comes to being compliant with their finance. So that's one of the reasons why I focus on this now, and I want to make my time available to those people who own businesses, especially the small business community. So let's jump into it. Key federal tax obligations. So what it is, so when you're opening your business, you want to make sure that you're opening with the correct structure. So we're going to focus business structure and taxation. So depending on how you were incorporated, how are you going to be paying taxes in front of the IRS? So the employer identification number, quarterly estimated taxes, and self-employment. So business structure. So when it comes to business structure, so we have many structures. One of them is a sole proprietorship. What it is when one person runs and operates the business. And that means that, a lot of you probably are entrepreneurs. So you just starting, you are the only one doing everything. So for that, when it comes to your taxes, you are supposed to be paying your taxes. When you register your business, you say, I'm going to be a sole proprietorship. So that means you're telling the IRS that you're going to be paying your taxes, all the earnings that you have in your 1040 under your Schedule C. And that income or that profits that you have is subject to self-employment taxes, which means that you're going to be paying Social Security and Medicare, in addition to federal taxes, to federal income tax that we all pay. If you choose a partnership, is when it's more than one person running the business. So that means you and another partner running and operating the business. So when it comes to taxes, you're going to file a form 1065 at the end of the year, and that form is telling the IRS the earnings that they have. And once you file that information, all the profits, whether are profits or losses, are going to be passing through the partners, which you are going to be reporting those profits or losses in your personal taxes. Another structure is limited liability company. And this is a more common like nowadays, because it gives you a liability protection. So you basically have the benefits of liability from a corporation, but also you tell the IRS how you want to be taxed. You can either choose to be taxed as a sole proprietorship, as a partnership in case there is more than one member being the owner, or as a corporation. So the benefit of the LLC is that you have, in case of somebody suing you, you have the protection that they cannot come after your personal assets. You can only come after your business assets, not the personal. So everything that you own in the personal side is protected. But as far as the business, that's something that you have to work it out when you do your contracts, to prevent that, and also, make sure that you have the proper insurance when it comes to that. And the profits that you earn through your LLC or the losses are transferable. So you do your Schedule C if you are a single member LLC, and then you report that on your personal income tax. C corporation, and this is a completely like this. C corporations are like a separate entity. They are corporations. They're owned by shareholders, and the corporation, they do their own taxes, the corporate taxes. They have they do the taxes, and then all the shareholders at the end, they have to do their personal taxes. So in this case, most of the corporations, the shareholders, they tend to face double taxation because the corporation pays taxes, but in case of dividends, also they pay additional taxes in their personal returns. An S corporation also, which is becoming more popular nowadays, and it's not a structure, but you can be like an LLC and choose to be taxed as an S corporation. S corporation is an election, how I want to be taxed for my business. So if you this is a corporation that has double taxation because you don't pay double taxes like a C corporation. So the profits and losses are passed through the shareholders, and they can pay taxes on their personal returns. So you're going to be filing for this type of, if you decide to elect to be taxed as an S corporation, you're going to be filing 1120S, and you're going to be paying taxes in your personal taxes, but not double. Just 1120S is like an informational report that your business has to do, and then you pay taxes on your personal. And to be elected as an S corporation, for you to have that type of a structure, you must meet certain criteria, which you have to be a U.S. citizen or resident. And so you cannot register as S corporation if you're living outside of the U.S. or if you're not a citizen or a U.S. resident. So I'm gonna talk about employer identification number. So what is it? So this is like a social security for your business. It's a unique number that the IRS assigns the business owners for them to utilize it when it comes to registering your business. So, and this is strictly for tax purposes. So why do I need a EIN? Is either whether you're gonna be hiring employees, whether you are going to be choosing, depending on the business entity. If you decide to go for an LLC, you need to get an EIN. If you decide to do a partnership as well, you need to get an EIN. The only one that doesn't require you to get an EIN is you're going to be doing a sole proprietorship. That's the only one. But other than that, all of the other business instructions require you to get that. And even if you're going to be doing telling the IRS or your state that you're going to be doing business as a sole proprietorship, I still, encourage you to get your EIN. So that way you separate businesses from personal. If you're going to be doing some retirement plans, contributing to retirement plans, you do need an EIN for your business. If you're going to be operating as a nonprofit, or if you're going to be getting some licenses at the state or local level, some of them might require you to get an EIN number. And why is important? Because, tax reporting in compliance, you want to make sure that you pay whatever income comes to the business under the EIN and not under your SSN. So you separate because you're going to be having expenses. So when it comes to that, it's easier and better for you to be more organized, getting an EIN number, so you can be better structured, and you can be more organized when it comes to your finance. If you're going to be hiring employees, like I mentioned before, to build your credit, the business credit is important, because when you open a credit card, or when you're going to open a line of credit, the bank institutions are going to ask you, do you have an EIN? So in that case, it's better if you decide to do your business to get an EIN. And for professionalism and credibility as well. Quarterly estimated taxes. Who needs to pay quarterly estimated taxes? So basically, all of us who are self-employed or who are running a business, we need to pay estimated taxes in case that we are not being, if that income is not in payroll, like if we are not being subject to withholding, basically. And also, if your tax liability, if you see that your tax liability in a year is going to be over 100,000, over 1,000, you have to start sending payments to the IRS in a quarterly basis. What does that mean? If you have your bookkeeper, right? Like if you see that your whatever is coming into the business, and then you subtract your expenses, and at the end you have a profit, and that profit you calculate the taxes, and then you see that you're going to be owing more than $1,000, then you have to sending quarterly payments, estimated taxes to the IRS. Otherwise, what's going to happen if you don't send them? Let's say at the end of the year for 2024, your tax liability come to be over 1,000, and you didn't send any estimated payments during the 2024, you most likely are going to be getting a penalty when you do your taxes, because the IRS is going to impose a penalty because you failed to be in compliance to send estimated taxes during the quarters. So the last, and I'm going to tell you the deadlines. The last for 2024, it's January 15, which is this coming week. So make sure, talk to your accountant and see if you have to send estimated taxes to the IRS. And not just to the IRS, but also some states also require to send estimated taxes. So the deadlines are the quarters. Like for the first quarter of the year, which covers January through March, the deadline is April 15. The second quarter from April through June, it's June 15. So you have to send before the quarter is over, so you have to estimate. For the third quarter, from July to September, you have to send it by September 15. And for the last quarter, you have to send it, which covers October through December, you have to send it by January 15. So keep those dates when it comes to sending your estimated taxes. Self-employment taxes. So whoever works in their own, they're subject to pay self-employment taxes. And what is that? That's when you work for somebody, they withhold self-employment taxes, which is payroll taxes, which covers Social Security and Medicare. So when you were working for somebody else, you saw a lot of in your pay stub, you saw a lot of deduction. The first two lines are normally the payroll taxes, which is Social Security and Medicare. So what is that? Like the total tax rate for self-employed individuals is 15.3, and that's 12.4% is for Social Security and 2.9% is for Medicare. And if you have employees, you have to pay half of this for your employees as well. So for 2024, if your profits are over 168,600, you still have to pay. That's the cap to pay Social Security taxes. So anything after that is not subject to Social Security taxes. But you do have to pay Medicare, which is 2.9%. Now I'm going to be talking about common tax forms that you're going to be seeing or as a business owners that you see frequently. So I'm going to be covering Schedule C, Form 941, Form 1099 NEC, and W-2 forms in case that you have employees. So Schedule C, who files Schedule C? This form normally is used for taxpayers who have who either work on their own, they have a single member LLC, or they just are sole proprietors. So they have a business, they want to put, they don't work for nobody, so they use this form to report any income and expenses. And what's the deadline for this? It's April 15 along with the 1040. You have to send your Schedule C with your 1040. You cannot send your Schedule C on its own. Otherwise, it's going to get rejected. You cannot file a Schedule C on its own. It has to be submitted to the IRS with your 1040. And the deadline, like I mentioned, April 15. Form 941, who filed this? Is if you have your business and you have employees, you're supposed to be filing this every quarter. And this form is basically telling the IRS, hey, this is the employees that I have, and this is the taxes that I'm paying for my employees. So you're paying self-employment taxes and you're reporting self-employment taxes under this form, and also federal income tax if you're withholding any taxes for your employees. What are the deadlines for this one? It's April is the of the months of basically 1 month after you have 30 days after the quarter ends. So for the first quarter, which covers January through March, you have until April 30th to send the form. For the quarter two, July 31st also. Quarter two covers from April through June. You have until July 31st to send that information to the IRS. Quarter three, from July through September. You have until October 31st. In quarter 4, from October through December, you have until January 31st to send that report along with the payments and with the money that you withheld for that particular period. If you fail to do that, you're going to be facing penalties and interest. Form 1099, and this is more common right now if you are an entrepreneur, because sometimes you perform services or you sell you perform services for another business. So if those businesses, if they pay you more than 600, most likely you're going to be getting a 1099 neg. Also, if you hire somebody to do a work for you, let's say you have a construction company and you're going to be paying, and you're not going to hire them as employees, because sometimes you have projects, you don't have your employees, but sometimes you get projects that you have to work on that, and you're going to be paying somebody to perform a job for you, and that payment is going to be over $600 during the year in total. This is a total, it's not just a one-time payment. Let's say I hire a photographer to do some marketing for me. So if this photographer charges me 200, I don't have to give him a 1099 neg. But if I hire him later in the same year for another services and it's 400, then if I add up both services, it's 600. Then I do have to send the photographer a 1099 neg for the services that they provide, because I'm going to be writing that off as an expense. And I'm going to be telling the IRS, this is the expense that I have for this line. And then they're going to be like, okay, you pay this person, this is the person, or this is the business that you pay to. And if they see that it's over $600, they say, hey, do you providing a 1099 neg? And if I didn't, I may get a fine for that. So, and also that person who received, they have to use that form 1099 neg to file their taxes. So out of us as entrepreneurs, we get a lot of 1099 negs because our income comes from several clients. Like we get here, here, and here. So 1099 neg, if you're an entrepreneur, or if you perform services for other businesses, you're probably gonna be getting that form to do your taxes. What is the deadline? If you have to issue a 1099 for somebody that work for you, the deadline is the end of January. January 31st is the last day that you have to file, and you have to make sure that that person, not the employee, the contractor, gets that form. So, and make sure that the IRS gets the form by the end of the month, January 31st. Otherwise, you may be facing penalties as well for late filing. W-2 form. This is in case that you have employees. So if you are an employee, if you have your business has employees, you're going to be giving this to your employees. So you have to, by law, you have to provide a copy of their W-2 by January 31st. And then you have to make sure that you send that information to the Social Security office and also to the IRS. Income reported. So this is a big one, because a lot of people, I get this question a lot, what do I have to report as an income if I work on my own? Any income is subject to sales tax unless there is an exception. That's by IRS rules. So most of us, small business owners and self-employed individuals, we're responsible for reporting all the income that we receive for our businesses, regardless of whether that payment is paid in cash, check, or via some like Venmo, Cash Apps, or other like sales. So we are responsible for reporting all that income that comes into our businesses. And in addition to that, also make sure to keep proper documentation, because that's going to be key when that's your backup for your taxes. When you're saying, hey, I earn, let's say you're reporting you make $100,000. So you make sure that you have your either invoices that you send to your clients, any kind of proof that you can back it up to the IRS when it comes to reporting that income. Also, other type of incomes that your business may have is like interest. Some banks, sometimes they give you interest. Also, if you have rental income for your businesses, some people, they own real estate and then they rent part of the business. So make sure you report that income as also. The sales of any assets. Let's say if you have a beauty salon and then you sell some of your equipment, that's a sale of assets. So income, the money that you receive for that transaction is subject to taxes as well. Any refunds or rebates related to the business. Okay, so this is the part I'm assuming all of you are waiting for, how to maximize your deduction. And there is no science in this. The proper way to maximize your deduction is to keep the proper documentation, because you're gonna be, and having your books in order. That's gonna help you to be very clear, to be organized, and to also do some planning ahead. So the benefits of maximizing your deduction is because it's going to reduce your taxable income, which at the end is going to be, you're going to be paying less in taxes because it's going to lower your liability. So what is the IRS, the allowance for deductions? So in order for you to take a deduction, the IRS allows you to take a deduction for your business, is the expense to be ordinary and necessary for the business, depending on the industry. It has to be ordinary and necessary. What does that mean? So you have to make sure that that expense is needed, that whatever expense that let's say you purchase, I'm trying to think of an industry that is common. Let's say you have a salon, and then you purchase supplies for that salon, hair colors, hair dryers. Those are necessary, because without that, you cannot run your business. So those are expenses that are ordinary and necessary. If you have, for example, if you have marketing expenses are necessary to run your business, so those expenses are also deductible in front of the IRS. Travel expenses, if you have to travel to, if you are a speaker and you have to travel to a conference, those expenses are also considered ordinary and necessary. So anything that is ordinary and necessary in front of the IRS. So that's why it's important to have a person who knows, who knows the tax laws and the tax rule, because you can tell them, and then they ensure that you're taking proper deductions and not just anything that, let's say because for an example, I'm going to go on vacation. That's not, the IRS can come and tell me this is not an ordinary and necessary expense. So, make sure, you put the correct expenses in whatever the IRS allows you to avoid penalties at the end, or to, you don't want to be falling in an audit by the IRS every year. Actually, a lot of people are scared of audits, but audits is a good way. I always say, if you are in an audit, don't panic. It's actually a good thing. If you have all the proof, you can tell the IRS, this is what I have done. And, they just need to do their job. So, as long as you're doing the right thing, it's nothing to be scared of. Also, any expenses that you pay or that you incur in developing your products or services. For example, if you are selling bracelets, any cost that you incur in that production is deductible. Some of the deductions that you may see is, office supply and expenses. So what's included in there is anything like paper, pens, software, subscription, and other operational tools for your businesses. Business meal, 2024 is 50%, and that includes meal with clients or business meetings, also with your staff, with business meeting with your employees and potential clients as well. Also, if you travel and you're going to stay overnight, also lodging, transportation, meals for that business trip are deductible. Home office deduction, you can either use the percentage method or the simplified method. What does that mean? So a percentage method, if you take a percentage, let's say you work from home, and you take a percentage of the space that you occupy there, and then you take all of the expenses for your home, like your mortgage, your utilities, and you say, if I'm occupying 10% of my house to do businesses, so we add up all the costs for your mortgages, utilities, and then we take a percentage and we deduct it in your taxes for your business, taking advantage of the home office deduction. And also you have the simplified method, which is a most common method, which is the square footage. You take a square footage of your home if you have a small office, and then we do the square footage deduction, which is up to 300 square footage that the IRS allows you to take that. But if you see, we have to evaluate. If you see that the percentage method is better for you, we will use that, or the simplified method. You cannot use both. Mileage deduction. So under the mileage deduction, you can either do the standard mileage or the actual expense method. And with that, you can only take either or. And also parking and tolls are deductibles when it comes to transportation. Startup and organizational costs. You may deduct up to $5,000 for startup expenses in your first year that when you incorporate your businesses, and in that it's included like legal fees, marketing and research, anything that you spend. If let's say if for your organizational cost of your startup cost was more than 5,000, you can still deduct it in the next years, not in the first year. You only have a limitation of $5,000 for the first year. So make sure when you do your taxes that you put in the correct numbers. You don't want to be putting, if you're spending more than $5,000, you don't want to be putting that amount if it's over 5,000. You want to make sure you only limit to put $5,000. Write-off, like, maximizing deductions. So only there is a section 179, which allows you to write off some assets in the year that they are acquired. What does that mean? So for example, if I have a construction business, and if I buy a machine to do cement, those machines are expensive. So I can either deduct over the lifetime and do depreciation, or I have the opportunity to take advantage and get deducted in the year that I acquired that machine. So if let's say the machine is $10,000, I can take that $10,000 on the spot there. And for the year of that, if I purchase in 2024, I can take the deduction there. And, of course, that's going to lower my tax liability at the end of the year. Or I can do, depending, I can also do the depreciation, regular depreciation, seeing what is the lifetime of that asset, and then depreciate it over the upcoming years. Also, professional expense and educational expense is a big one, because as an entrepreneur, we're always educating ourselves. So make sure that you keep proper documentation for those expenses, and because those are tax deductibles as well. If you're an entrepreneur, you work on your own, self-employed, you pay the cost of your health, vision, or dental your health insurance, anything that comes to your health cost is deductible. And also IRA contributions. If you're self-employed, if you're contributed to an IRA, you can also deduct that in your taxes. Some of the best practices to maximize deductions is basically what I mentioned before. Keep detailed records. So receipts, invoices, those are key to maintaining proper documentation. Separate business from personal expenses. So business and finance, don't mix them. Don't mix them. Don't use your credit card to buy your personal credit card to buy your business supplies or your business assets. Separate and use your business debit card or credit card to buy businesses, and your personal to buy personal. Invest in an accounting software like QuickBooks, Wave, Xerox, because that's going to help you stay organized. I believe depending on the subscription, some of them are as cheap as $30 per month. So make sure that if you're having a lot of transactions during the month, so make sure you invest on that, because that's going to help you stay organized when it comes to your expenses, to your income, and depending on some businesses, you might be paying also sales tax. So, and another way to maximize your deduction is just to plan ahead. See with your accountant, have a conversation. Don't just look for your accountant or your tax professional at the end of the year. Make sure that you are in constant communication with them, like at least have quarterly meetings with them, in case that you're not meeting with them every month. But at least I always suggest quarterly meeting, setting up a meeting to see where you are and how can you plan ahead, and how can you maximize your deductions, because there are others ways to reduce the liability, not just through your businesses, but also taking advantage of other tax savings that the IRS offers. Stay in compliance. Why is important to stay compliant? Basically, staying compliant it's very important for small businesses, because you want to avoid penalties and interest. It's crucial that you stay compliant, because if you're not paying your taxes or filing your forms on time, you're going to be facing penalties and interest. And that's not good, because at the end, you're taking money from you to pay the IRS or to pay the state. or to pay your local municipality, depending on, on why you didn't file or you didn't file on time. So, and if you want to maintain a good health for your business, stay compliant. And I'm going to be talking about the deadlines for the different type of structures. So for federal income tax returns, sole proprietors and single member LLCs. So what do they have to file? It's 1040 with their Schedule C, and the deadline for that is April 15, unless they file an extension. If you file an extension, that is going to extend until October 15 for personal taxes, and for single member LLCs who normally file a Schedule C only. If you're a partnership, the deadline to send your form, or S corporation, the deadline to send your taxes to the IRS is March 15. So if you have a partnership, you are doing business with a partner, make sure that before March 15, those taxes are filed. Also for S corporations, unless you file an extension. If you file an extension, it's 6 more months until September 15. If you have a C corporation, the deadline, you're going to be filing 11/24. The deadline is April 15. Quarterly estimated taxes, I already went over that, but I want to do a refresher. So the quarterly estimated taxes is the 15th following the end of the first quarter, June 15, even though the quarter is not over. For the second and third quarter is 15 days before the quarter ends. And for the quarter four is 15 days following the end of the quarter, which is January 15 of the following year. Let's say in this case for 2024, it is January 15 of 2025. This is an annual report, and this is basically unemployment tax, annual unemployment tax, and it's due January 31st of every year. W-2s if you have employers, or Form 1099s if you pay any contractors during the year, must be sent to the IRS and to the employees or contractors by the end of this month, January 31st. Also, keep in mind that this information that I'm sharing with you is mostly federal. When it comes to your state, make sure that you also monitoring the deadlines for your local, for the state that you're residing or where the state that you're doing business in. So, and that may include sales taxes, excise taxes, state taxes in general. So make sure that you have sometimes the state changes. Not every state deadlines is different. So make sure you follow that with your state to stay compliant, because the compliance is not only federal, but it's federal, state, and local. Benefits of staying compliant. One of the main benefits is to avoid penalties and interest, also building a solid foundation for your business, and because that's going to help you grow. That's going to be the base. You're building the foundations, and you're going to see how your business is going to start to good growth and elevate. Gaining peace of mind. Peace of mind is priceless, right? You're reducing the risk of getting audited every year, or just even if you get audited, you have the peace of mind that everything is in order, and to avoid any legal issues as well. Any questions?
Amazing. Thank you so much for all of that information, Cristy. I know that in the chat, I took notes. This is like a really good starting point to now go get all that information and get my paperwork started. So I appreciate that. But I do know that we have a couple of questions about deductions, specifically, like we all use our phones for social media for marketing. A lot of us are doing that ourselves. And so how much of our like phone bill, let's say if it's $100 a month, which for me it's a lot more than that, but how much of like your phone bill can you deduct? Or like someone asked, like they work from home and they eat at home, so can they deduct that food every day? So maybe you can talk more about that.
Sure. For phone, depending, if you only have one phone, which you use your personal for personal and business, so you estimate a percentage. Let's say 50% of the phone is for businesses, and then you take 50% of the bill for the whole year, and we apply that to the deduction, to the phone bill, the total. So if you pay $100, let's just say that's $1,200 in the year. So $600 is gonna be used for business. So we take the deduction. If it's more, if you see like more, then you put more, like 80%. I use 80% of for businesses, basically. Or if you see that the cost increases, you may just want to purchase a business phone and use, and so you can deduct fully the 100% of the business phone or or your cell phone. But normally it's a percentage.
I see. And also the 1099s, we all, like a lot of us do freelance work, like you're saying. And so if the person that hired us, if they don't file that paperwork, we can file that on our own.
Yes, you can, because I'm sure you're sending an invoice, so that's your proof that you send the invoice and they pay that. Even if you don't receive a 1099, you still have to report that income. If you
Do
do
we need
it,
to,
well,
because what if they, like someone said that they ghosted them, right? So what if it's, March 10th and we haven't received a 1099 and we need to file it ourselves? Are we now going to be penalized for filing that paperwork?
no. You're not.
Okay.
If you're supposed to be the recipient of the 1099
Yeah.
NEC and you didn't get it, you're not being penalized for that as long as you report that income. Because you may want to reach out. Let's say it's March and you haven't gotten the 1099, you're expecting a 1099 from them. You may reach out and say, hey, by the way, I performed this service for you. Are you going to be filing a 1099 for, because I want to do my taxes? And they say, no, I'm not going to do it. You still have to report that income, even if they didn't, right?
Right.
But report that income. That's my advice.
Okay.
Because if they do, let's say they don't file it and they file late because their accountant admitted, oh no, this is an expense that you have to put in your taxes, and they realize that the payment was over $600. So the accountant for a person is going to file the 1099 late. It's okay, they will be paying their penalties and interest, but they're going to be sending a copy to the IRS, and the IRS eventually is going to have that copy, and then the IRS is going to be matching with the recipient tax ID or Social Security. And if they saw that you didn't file that year, you didn't file that income, they're going to be like, hey, sending you a letter, say, for this year you have this income and you didn't report it. So that's why report that income, even if you didn't get the 1099. Now, when people are getting paid through Venmo and Cash App or sales, well, no sales, mostly Venmo and other applications, they if the amount exceeds, if I'm not mistaken, based on the latest IRS, they exceeds $20,000. The IRS is sorry, that application is going to be sending you a 1099K. And that includes all for credit cards. If you have if you have those software that you accept credit card payments, so the merchant is going to be sending you a 1099K. But even if that's only if the amount is over a certain amount. But in case that you don't get a 1099K and you receive payments for businesses that you perform through Venmo or those applications, please report that income.
Perfect.
To
And then
avoid.
I have a
Go ahead.
question, and then we can open it up to others who have questions. You mentioned that we should have separate bank accounts, but that's a little too late for me. I just use my bank account, and I do keep track of everything in an Excel sheet. But what do you? I mean, I know the suggestion is to now open one, but if I've already been doing it for the past year, is that bad? Am I going to get in trouble? Am I going to jail?
I, no, first, that question, are you incorporated?
LLC.
LLC. So when you open your LLC, depending on who register your business, they should have advised you to open a bank account. If you have a business, the next step, the part of the opening of a business is you have to, once you register, you have to go to the bank and open a bank account. So if you haven't done it, do it. Because that's gonna be separating your personal for finance. If you have a proper documentation, that's okay. But if you haven't done it in the past year, it's okay. They're not gonna penalize you for that, but do it, because
Okay,
eventually, as you start growing, you don't want to
for sure.
continue doing that under your personal account, because that also, if you have an LLC, you are protected by the liability of the LLC. That means that they cannot come after your personal assets. And if you have it in your personal account, they can come after your personal account, because you're gonna be
I
having
see.
trouble seeing, hey, no, this income was personal, this income was business. So
I see. Perfect. Thank you. Does anyone else have any questions? Maybe we can do the raise hands.
I know also you mentioned also about the home deduction when you were
Yeah,
meals eating. If you so the IRS allows for you to eat, but meals are deductible, but not like your regular daily meals, because we all have to eat. And just for example, if you go to work for somebody else, that meal that you purchase is not deductible, right? So the IRS allows you when you are an entrepreneur to deduct up to 7% of your meal. But that also has to be ordinary and necessary. If you do home meals, yes, you can assign a little portion of the meal. Let's say they give you a value like $10 is a reasonable value that you can put in for meals. But if you're gonna go, if I'm working from home and I'm gonna go in a fancy restaurant and I'm not meeting with any clients and my bill is like $300, that's not an ordinary and necessary cost. So for the case, it won't be, the IRS won't take that deduction. You know what I mean? So
Yes.
the expense has to be ordinary and necessary. So if you're working your regular hours doing like at home from you assign your hours 9 to 5 or 9 to 4, that meal is not going to be deductible. But if you're over staying like to work at home for long periods of time, more than your regular hours, if you order food from, it has to be ordinary. No, you don't have to order an expensive meal. Or if you pay somebody to prep your meal while you are continue working, you can deduct the cost of that as long as it's not a huge amount. Now, if you take out your staff for a Christmas holiday party, yes, the full cost is deductible because it's occasional and
Right.
it's in recognition for the people that work with you.
And it's normal, people do that. So yeah, I understand. I'm not sure that we have much time for more questions. Hopefully we can get
Vanessa
to Pam. Yeah,
had asked a question early on in the chat. Can we do that one first?
sure. What was that one?
So the question was, are there differences between being taxed as a sole proprietor versus corporation under an LLC?
Yes. The difference is if you are taxed as a sole proprietorship, you have to do a Schedule C if you are a regular sole proprietorship. But if you are a corporation, you have to file Form 1120. If you decide to elect to be a corporation, a C corporation, you do 1120. If you tell the IRS that you want to be an S corporation, you have to do 1120S. So the forms is the different, and the deadlines also, because an S corporation has a different deadline than the C corporation and the sole proprietorship. Now, when it comes to taxes, sole proprietorship are subject to self-employment taxes. So in addition to paying your regular federal income tax, which is normally what we all pay, which is depending on the amount of money that you earn, you're going to have brackets. Like some of them are at 10%, some of them are 12, 18, 15, and goes on and on. But in addition to that, you have to pay 15.3% for self-employment taxes, which self-employment taxes only covers Social Security and Medicare. So that's why when it comes to estimating your taxes, I always suggest send no less than 25% of your net profits every quarter to the IRS. And 25 is being like, saying that you are in the very, very low tax bracket. Because normally I say 30%, send 30% to be okay.
But at the least 25%.
At the very, very least, but
Gotcha.
normally 30%, 35%. So it's important. That's why it's important. I mentioned meet with your accountant at least every quarter, because they're going to be evaluating how your business is running and how much you can start sending to the IRS for estimated taxes. Because at the end, you don't want to be underpayment, because if you are underpayment, you're still going to be paying the penalty. They're going to put a penalty, regardless if you send, let's say if you're underpayment for $10, you don't want that, because the penalty will be there. Your accountant probably will be able to, ask for a abatement and talk to the IRS to forgive you if it was a minimum,
Right.
the underpayment. But that's why it's important to prepare.
What I'm understanding is that we all need accountants.
Somebody who
Basically.
can advise you, yes.
Yeah.
You need an accountant, especially because you're running a business.
Yeah.
If it was just a personal, okay, yeah, you don't have to see the accountant, you don't have to invest in an accountant. But if you're running a business, you need to. It's a good investment, because you want to stay compliant. You want to make sure that you're doing the things that you're supposed to be doing.
Perfect. Thank you so much, Cristy, for this. Everyone, please connect with her and hire her for her services. I'm definitely going to schedule something with you. And thank you everyone for being here. I'm so excited for 2025. What a great way to start the year, right?
Thank you so much. Thank you for this is my contact info.
Yeah, Cristy, if you want to click the LinkedIn document, like you have it's all there for you. Like your information is there so that they can contact you. And then we
Okay.
can contact everyone else too. Happy Saturday. Go listen to Bad Bunny's album. Stay sane, stay healthy. I'll see you guys on the gram for
Bye-bye. Take care. Thank you for
bye.
having me. Bye-bye. Have a good
Bye.
Saturday, everyone. Bye-bye.